Thank you for joining me, and I guess this is the inaugural. Go back and watch the pilot if you want to watch episode 0, but episode 1 of LLP, and I've been looking at the markets lately, and these are my own personal charts. The prices are based on the New York spot and I think the London Metal Exchange, so if you're seeing variances, I try to get pretty close to the close, but sometimes markets reopen, sometimes these things are sensitive to global shifts, including the Dixie, so the dollar index. So yeah, in case anybody is looking at this and they see any errors, you can correct me after the fact. That's okay. But here's today, and it was a huge, huge day for metals. You can see everything pretty much went up from its dollar price yesterday. Another tough day for stocks. It was identical to what we saw on Friday, where I think gold had its big day, silver had its big day. But silver is the big sleeper. I mean, if you look at silver on the week, it's done better than pretty much everything. Copper kind of got its butt kicked, but a little bit of recovery today, and the dollar's been flat overall. I'm going to revisit and even talk about this chart more as I go, but right now I just want to talk about the value of metals and gold. It's becoming a more popular topic even on mainstream business and finance channels, so I don't feel like I'm too kooky by walking people into it and talking about it with respect to politics, because it is important politically. I'm not going to go too heavy on this chart and what it means. I will break it down like directly later on, especially on big moving days. I'm not going to do it necessarily every day, but this is a good example of how a lot of the volatility in the market caused what happened. I think what happened on Friday is it was a lot of hedge fund money that went into gold on a bad day for stocks, and I would bet, although this is all just today, that is what we'll see when all this stuff gets looked at in hindsight. Again, uncertainty about the private market causes people to move into metals, especially when there aren't a lot of other good currencies to go on. And the US dollar generally has been resilient in all of this. Everybody's been waiting for it to crash or worried about the US dollar because of the policies that we've been enacting over the years, all the quantitative easing, all of the issuing of money, the cash, the liquidity. But it's kind of a mystery where all of our common sense notions and all the conventions of economics tell us that we should be seeing inflation in times like this. But every time we hear Jerome Powell, the Fed chairman, talk, he's talking about we're not seeing inflation, we're not seeing inflation. He's to the point where he's probably frustrated. He wants to create inflation, and he can't create inflation. And why he can't create inflation goes into what I want to talk about today, because I'm not going to go too long on the metals and too long on the numbers. I will later, but I'm going to split it 50-50. I want to introduce you to the idea of the dollar milkshake theory, and if you haven't heard of it, you may not have. It's Brent Johnson is the guy who named it, and if you want to, you can look on YouTube for Brent Johnson Final Showdown or Brent Johnson Dollar Milkshake, and you will see he has a lot of presentations and stuff like that. If you can get it sort of out of the horse's mouth directly. But briefly, I hope I can do this all in one shot. No edit. Here we go. Because I don't want to. It's hot. It's rush hour, and I can't close my window. So, but the name Dollar Milkshake Theory, it was named after the slant oil drilling scene in the movie There Will Be Blood, if you've ever seen it. And the oil is the global liquidity, the cash, everybody's money that's coming out of all their central banks. And the slant drill is the US dollar. And so, like I said, going back to that graph, the DXY, the dollar index, is the graph that you can use to track the phenomenon when you look at precious metals like gold and silver to see that stability, because the dollar index is not equal to itself from day to day. So you have to measure your gains and measure your holdings against the dollar. Is the dollar as strong as it used to be? Is it a weak dollar or a strong dollar? The Dixie is an index, so it's not perfect. It's a rubber ruler itself, but it's better than nothing at all. It's created by measuring a basket of major currencies like the euro and the Swiss franc, and I think the yen is in there. And if all of those are performing poorly and the dollar holds, the Dixie will go up. And if the dollar doesn't do well and they hold, then the relative value of the dollar will go down. The normal is supposed to be 100, and for the last week we've been a little bit under that, so the dollar's been a little bit weak compared to its historical value. But again, it's a man-made measure, so don't take it too seriously. The long and the short of the Brent Johnson dollar milkshake theory is that the dollar will go up before it goes down. He believes that, the laws of economics still hold and gravity will still pull things down, but before it goes down, there's going to be a lot of updraft. And it's due to a very unique position. I think the dollar's in, and he agrees, it's the first world currency that's a pure fiat sort of paper, debt-backed currency, where that's the sort of currency of reserve, the currency of closure, but itself, there's nothing behind it. There's no reserve behind it. And so since there's no competitor to the dollar as far as being the currency of clearance, the more instability you see in global markets, the more people run to the US dollar for refuge, which puts more strength behind the dollar. And some people will run to metals, and they are, and they have, and the graphs from Friday, the Big Friday, and today are showing that, especially when private equities, stocks and stuff aren't looking good. But even if you're running to metals as the global currency of closure, the US dollar will still probably be the pass-through for most of these commodity transactions and retail transactions in gold and silver. So even that, there will still be a sort of a dollar bump because of its dominant position as in the world economy. And so the increase in demand for dollars will keep the dollar rising with gold over time, is what Johnson is saying, as other currencies struggle. And you can look at Turkey and Argentina hypothetically as sort of canaries in the mine shaft, and the struggle that basically other countries are going to experience very similar things because they can't service dollar debt as easily because of the updraft from all the other problems the world is having as we're going into this world recession. And you can look at, if you want to look at an even more extreme example, even Venezuela can't get out of this. Venezuela, who they don't like the United States at all, their elites still have demand for dollars, and they still would like US dollars because that gives them access to the system, the world system of closure. The dynamic is causing the US central bank, the Federal Reserve, the Fed, to lower interest rates to cheapen money, because if money is too hard to get, even for the Fed, the dollar is too strong due to the liquidity feedback loop and the global instability, then the United States government and the Federal Reserve will be unable to service the payments on their increasing debts. And the United States is going to be running deficits for a long time. And so they're debtors too. And as debtors, as big spenders, they want low interest rates too, because low interest rates are what debtors want. Debtors want cheap money. High interest rates are what creditors want. Creditors want strong money. Savers want strong money. Spenders want cheap money. They want to be able to get loans at low interest rates so they can, spend money or service their old debts. Well, the Fed is a debtor. The U.S. government is a debtor, so they don't want high interest rates. That's going to make it hard for them to service their own overspending in the past, the same way as if you had a credit card, you would not want a high interest rate on your credit card, you would want a low interest rate on your credit card so that you could spend more money and pay it off more easily. Especially if you had inflation and money was getting cheaper over time, then you could pay it off super easy. So in close, and I'll probably revisit these topics again, but I just wanted to introduce you to that chart and start thinking about intrametals and the metal ratio and how the silver performance against all the metals was even strong. Forget about in terms of its previous price in dollars. As the dollar dipped a little bit, it can take away from some of those gains in terms of dollars, but overall gold and silver did very, very well this week. And obviously gold's been on a run for a month now. But we're going to march into negative yielding bonds and negative interest rates with all this liquidity pressure coming from around the world, and this updraft will eventually explode the US dollar system, causing the next great global recession, at least in theory, in Brent Johnson's theory. So I've been doing a lot of stuff, and I've been working on some longer projects and shorter projects, but I'll do more LLPs in the future. Thank you for listening. If you have any, advice, you think there should be more or less information on that chart, or you're confused about something, just let me know below and I'll address it with more attention next time. Hope it's nice and warm where you are. It's certainly nice and warm here, and have a good day, night, evening, whatever the time is, wherever the time is. Goodbye.